This is something, I remember probably in the second year of my career, this is something I went and wrote out, which is, what are the definable characteristics that define a trend day? Now, it's going to sound a little bit cliche, which is that, sometimes the best lessons you learn are from the biggest losses you take, but in essence, these characteristics, I only learned to define them because of taking losses consistently on trend days. At the start of my career, I was very much a trader that went counterflow. I wasn't too interested in going with momentum. I didn't quite, I thought the with momentum play was very much an algorithmic, sort of infiltrated area of trading, and I thought I have a better chance standing up against it. As you go through it, you learn in life that certain trends you don't want to fade and certain trends you do want to fade. And that's the key takeaway, is that I learned through being able to identify the characteristics of a day, when to fade and when not to fade. In other words, when these characteristics I'm going to teach you now were in the market and they were present, you'd never see me fading a market. Okay, I might not have been the best person in terms of going with the trend, but I was never fading the market, and that really, in the long run, ended up not just saving my career, but saving me a lot of money along the way. Okay, so let's now go through it and let's talk, about these characteristics. The first is volume and volatility. Now, I'm going to explain this just one for one, and then I'm going to bring it onto the chart so you can understand a little bit better. Okay, but what we're looking at here now in terms of volume and volatility is we ultimately, when there's trend in the market, we want to see both volume and volatility pick up. Okay, the reason being is that when we have a trend day, it's signaling to us there's large time frame participants that are initiating in the market. Now that means they're bringing business to the market, they're taking liquidity, and they're influencing the direction of price. So by that very definition, we have to see, in order for it to be a trend day, we have to see a pickup in volume and volatility. Now what I'm going to show you in the profile in a minute is that the volatility looks on a profile just looks very, very revealing, because we can see the size of the TPOs quite nicely. Now if each one of these lines kind of represent the sets of TPOs, volatility expansion is just where, if we're seeing, for instance, very tight little distributions, maybe something like that, and suddenly we get one candle or one TPO that almost does an entire range, that's ultimately volatility. Okay, now the two key questions we have to always answer, and this is the key if you really want to become good at identifying trades, it's not just about knowing that there needs to be volume and volatility, but it's about knowing when there should be volume and volatility and where it's likely to occur. Okay, because it's that when and where that's ultimately going to dictate when you're getting on, with the breakout or with the trend, and when you want to avoid, going against the trend effectively. Okay, the same goes for the delta then. Okay, now delta is a relatively new concept. This wasn't around when I first started trading. There was no such thing as a market delta in 2011, 2012. But again, what this is in essence is it's telling us the net interaction. Now, what's beautiful about the delta is that it's thrown in, typically what we always used to see was just, a candlestick with the volume and the size of the candlestick. Okay, so from that, we could extract only volume and volatility. But now throwing in the delta is giving us an added element, which is how are the buyers and sellers actually interacting? Okay, and this is adding another form of being able to recognize a pattern, because what you're going to very quickly learn is that in a trend day, the characteristics of delta should always be accumulating the direction of the trend. Always. Okay, not sometimes. As a rule of thumb, you always want to see in an uptrend the delta accumulating towards the upside. Okay, so you want to see delta picking up over the course of the day. Why? Because we should see more buy-side interaction versus sell-side interaction. Okay, the buyers should be more willing to lift offers than the sellers willing to hit bids. Okay, again, the where and why is important. Where is the delta being accumulated, and why is it being accumulated there? Okay, very often what you're going to see is that the most amount of delta is not going to be accumulated on the pullbacks. Okay, why is that? Because the sellers are ultimately bringing prices back lower. Right? The real response, the real build-up in delta and the pickup in delta is going to occur when we start making new highs. In other words, taking out previous highs of the day, and that's when the delta picks up. Again, the where and why is extremely pivotal to learning about the characteristics of a trend day. Okay, now the last one is obviously price response. Okay, so it's how is the market responding with all this high volume volatility, with this delta change? What is price doing? Okay, is price going up in a grinding fashion? Is it going up in a straight line fashion? Is it swinging around? Okay, we need to be able to identify the type of price response, right? In a trend day, the natural characteristic is for very directional type price response. However, some trend days you do just get this constant slow grind the entire session up. Right, so again, it's about learning to differentiate between the two so that you can apply the correct strategy. Okay, a trend day is a trend day. How you execute it depends on the conditioning behind that trend day or the characteristics that are defining that trend day. Okay, now two key things, and this is where profiling. If you haven't got a profiling tool, this is where hands down the profile tool is extremely valuable. Right, and I'm going to show you this in a minute, but what you want to always look for, one of the key characteristics to add to volume, volatility, delta, and price response are low volume areas. Okay, now all the low volume areas where a market moves away very quickly from a specific set of price points and is unable to trade there, it's unable to facilitate trade there. Again, I'll show you an example in a minute. And then the last thing is the nature of overlap, and that kind of ties into this concept of the price response. How much is price overlapping? Okay, as we can see in this very trending example here, there's almost no overlap of price. In the second example, we can see a lot more overlap of price. Okay, again, the degree of overlap is very important to defining what's likely to occur next in this trend day. Okay, so let's get to it then, and let's have a look at this and see how it plays out. We obviously have got the 21st of September as our example, so let's have a look here. Okay, now I'm going to start off by showing you the daily charts and give you an understanding behind why we were looking for this breakout. Okay, daily chart, Euro Dollar FX. What we can see is that the market kept stalling around this 1807 to 1830 area. Okay, we can see it provided a resistance a number of times, and we were looking for the breakout of those, 118 area, effectively looking for an acceleration to the upside. Okay, now again, this is not a Harry Hindsight type stream. This is very much, we obviously, this was tweeted out by myself well in advance. So we were looking for that play. But looking for a play and executing a play is two different things. Okay, looking for a play, yeah, we can all identify when a market might go up or down, but we can't all identify when's the exact moment to be executing for the up and down. Okay, and that's what I'm going to show you now. So what we're looking at, we're going to get the profile up first, and I'm going to start off by explaining overlap to you. Okay, so this is obviously the 19th of, the 20th. Okay, sorry, yes. So this is obviously the 20th, ignore the 19th, that just starts at 11 o'clock last night. So this is the day in mind, it's the 20th of September. We can see that the market was firmly inside the previous day's range, and note the overlap. Okay, so every one of these lines is a TPO, and ultimately notice how you've got almost a complete overlap of the K's and the L's, a complete overlap of the M and the L's, a complete overlap of the N's and the P's, Q's and R's, lots of overlap. So in the Q and R, we're trading over the same sets of prices. That's ultimately all overlap is. It's telling us there's a very much an acceptance for these prices at the current point in time. Okay, now what we're looking out for, what we're observing with the profiles very often is when that acceptance changes. Okay, because when that acceptance changes, we need to be aware of that because that's the potential for flow in the market. Alright, so the first thing is we're looking for that degree of overlap for either the market accepts or doesn't. The second then is the measure of volatility. Okay, so in other words, volatility just measures how wide a number of prices does a TPO trade over. Okay, so we can see very little volatility from TV all the way up to the the L's and the K's. We see the UK session or the European session starts on the M-prints. We see a bit of volatility, and then around the Q's and R's, the most volatility of the day. Okay, we then get a volatility pickup again or continuation of that volatility from the Q's and R's, and we see the maximum volatility occurring on the X's. Okay, so again, you can see why the profile is so dynamic. It not just shows us, volatility measurement, it also shows us the degree of overlap. Okay, so that's all being said. These are indications, guys. They're not telling me to buy. They're not telling me anything other than what the current nature of price response is in the market. Now, our key area we're looking at is those 96s. Okay, why? Because that's the breakout area. That's the area we want to see how the buyers and sellers engage and interact. Now, the key is that just before we get to that price point, notice what the T-print does. Okay, widest volatility of the day, also an outside candle, and also breaks out of that double top on the dailies at 87s. Okay, so that was our early clue, and it came before the key break of 96s. I'm going to show you what that looks like in the footprint in a minute. But that's what got us engaged. That's where we were looking for the longs now. We're starting to get prepared for this breakout, and we want to be long ahead of the 96s. Okay, so we're getting long T's, and eventually we do get the break above those 07s, and more importantly, we get the response. Okay, so important on key breakouts. You need to see that response. You need to see those buyers engaging in the market. Okay, eventually market obviously ramps a good 50 ticks, and then what do we see for the rest of the day? A large amount of overlap. Okay, now I'm just going to close this up, show you what a low volume area looks like. So low volume areas on the profiles are represented by single TPOs. In other words, only one letter. Okay, now you can think of it as, as you know, the market's unable and unwilling to accept this area of prices. It wants to navigate very quickly away from the set of prices. Why? Because it deems the set of prices a discount at that point in time. Okay, so listen to that logic. The market deems these prices a discount at this point in time. Okay, so if the market deems this this area as a discount, this now becomes a significant area. Okay, more importantly, it tells us something very significant about the market, which is market participants think it was an extremely good buy down here. Okay, so the likelihood of us taking that out at any point in time all depends on the aggression of the sellers. So if the sellers manage to get back here, right, it's telling us a nature about the buyers. It's telling us that the buyers are not as strong as they had originally shown. Okay, so the longer sets of single prints lasts, the more powerful the buyers are. Okay, that's the general rule of thumb. And again, all these concept guys, it's dealt with extensively in the volume profile course. But that's the general rule of thumb, is the longer a low volume area holds, the more accepted it becomes that this market, obviously, buyers are starting to build up energy. Okay, now that's pretty much the profile. I want to now just talk a little bit about the execution side using the footprint charts. Okay, so again, there's two ways to execute this breakout. Like I said, a little bit preemptive on the early clues. Okay, and I just need to go back to yesterday quickly. Okay, so we're going to go all the way back to around about midday, 12 o'clock. And we're going to start off right on the 12 o'clock session. So here it is. You can kind of see straight away, we pivot off those. This is that outside candle we're looking at. And we get this really volatile candle. And this is where the footprint's great as well. If I show you all of these candles, okay, every one of these is a 5-minute rotation. This is the largest 5-minute rotation of the entire session. And it occurs just before the breakout. Okay, so that's your clue. There's your clue right there. Notice the delta. Okay, went from 1,000 to almost 1,500. So a 50% pickup in delta, a 500% pickup in volume, and all of this just before the break. That's the clue. That's the subtle clue just ahead of the break. A little bit of consolidation for 10 minutes, and then it begins. Okay, then the real route begins. 6,000 contracts. Again, note, 3,000 was big earlier. It was 500% bigger than the previous. We've now got 6,000. Okay, highest volume on the day. Takes out the 06s as well as the key area at 15s, another 6,000 trades. Okay, now what's very, very interesting if you're watching this, okay, and this is a very important clue with the footprint. As the market's going higher, look what the delta does. Okay, so the market goes up, it finds willing sellers. More importantly, those sellers are very aggressively hitting the bid, but what's price doing? Okay, price is not going down. So if there's very aggressive sellers hitting into the bid, but price is not going down, what's that telling you about the market? It's telling you about the nature of the reloading at the extreme prices, which is showing you how strong these buyers are, how intentional these buyers are. And that's the clue right there and then. If you weren't long down there, that is another clue that you've got to get your socks long here. Why? Because those sellers are hitting it so hard, but they're not getting price down, which means that the minute those buyers, or the minute the selling stops, those buyers have got plenty more to come. And that's that next move. Okay, bang, another 7,000, another 6,500. Another 5,000. And there it is, guys. There's your move. Within a space of 45 minutes, we move from that key break of 1800s or 118s all the way up to 118.50. 50 ticks, straight line. Very little risk. All based on the footprint chart. Okay, so that is our key breakout. Now, if you want to learn about breakouts, go through the footprint course. Go do the footprint course. There's a free section all on the breakouts in the footprint course. So go take the free section. Have a look at it. Okay, there's so many little subtle clues these markets teach you if you're willing to learn the patterns, if you're willing to recognize the patterns. Okay, guys, so that is our play. Now, the last thing I want to talk about is just, when we did finally come down late on the afternoon, I just want to show you, what it looks like when those buyers engaged again. And this is the real key, is we could see the market just spent, the entire afternoon drifting. And the best way to explain this is probably to get a little bit of a longer term time frame, or a candlestick. Okay, so what I want to show you is yesterday afternoon. You can see straight away, notice how, where are we looking here? Sorry, wrong market. Okay, so we can see, that's our little breakout candle. And then note what we do for the next 4 or 5 hours. Okay, what did we talk about when we spoke about TPOs? Overlap. Notice the overlap occurring here, guys. So much overlap, and price is not moving down. Okay, notice 1, 2, 3, 4, 5 candles in a row, 6 candles in a row without taking the previous high. The moment we take out the previous high, straight back to the top. Okay, so had you missed this entire move, just have to be a little bit patient, let the market show you where those buyers were, i.e. the green candle, look for the break of the pattern, a simple pattern of breaking the low highs, and you got your, again, another 40 tick move to the upside. Relatively straightforward. One breakout opportunity, one level identified, a bit of price action, leaning on the market profiles, leaning on the footprint chart, and just taking the simple trades and executing them simply.